Today we're going to be using data to help us prepare financial ratios to provide us with some performance measures on companies. We're going to be completing the problem from Chapter 4, SE11 on page 229 of our financial accounting textbook. And the problem is going to utilize a variety of data to prepare financial ratios for the profit margin, asset turnover, cash flow yield, debt to equity, and return on assets, and the cash return on assets, and the return on equity ratios. So we will start with our profit margin. Our profit margin, as we all know, tells us what level of profitability we've earned on our sales for the given financial period. This ratio will tell us the percentage of each sales dollar that actually results in net income. So, like with any other ratio, we'll start with just writing in the information on how to calculate the ratio. What are the variables that actually go into completing that ratio? So we'll start here with net income, and it's net income divided, net income over net sales. And in this particular problem on page 229, the net income data for this particular problem we had to calculate. So in order to calculate our net income, we have to take the information that's provided in the problem and actually complete a little mini income statement. To calculate our net income, we're going to take the variables that are provided in the problem, and those are net sales, and we're going to subtract the cost of goods sold. So our net sales are $260,000. Our cost of goods sold were $140,000. And when we take the 260 and we subtract our cost of goods sold, we get a gross profit of $120,000. We subtract from our gross profit our operating expenses of $80,000. And we get an operating margin or profit from operations of $40,000. And then we will take away our income taxes of $10,000. And we will get a net income of $30,000. That's the number we will use as our numerator in this problem. So our numerator is 30,000, and then the variable that was already given, our sales, was 260,000. And then when we divide our 30,000 by 260, we get 0.1153. And if we multiply that by 100, that will give us an 11.5% profit margin. So if we wrote this down below, this would look like 260,000 minus 140,000 minus the 80,000 and minus the 10,000 gives us the 30,000 of net income. Okay, so that's our profit margin. Let's look at our asset turnover ratio. The formula for the asset turnover ratio is net sales divided by the average total assets. And if you recall, when we discussed our average total assets, in order to get the average total assets, we need to use our beginning assets and our ending assets and divide that by 2, okay? And if you recall our discussions about about the asset turnover ratio, the asset turnover ratio measures how efficiently assets are used to produce sales. In other words, how much revenue is generated by each dollar of assets. So in this problem, it tells us that the company's beginning assets were 200,000, and our ending assets were 240,000. So that comes out to an average total assets of 220,000. That will be our denominator. And then our numerator is the net sales, and our numerator is 260,000. And then when we divide that out, we get an asset turnover ratio of 1.18 or 1.18 times, okay? So what this basically means is that for every dollar of assets invested by this company, they're generating 1.18 dollars in sales. In analyzing that, you would look at what the company has done in the past and compare that 1.18 to past performance, as well as what other companies that are of a similar size and nature, how their average asset turnover compares. Okay, well, the next ratio that we're going to analyze is the cash flow yield. And the cash flow yield measures how much a company's operations generate in relation to its net income. Again, we're going to look at, well, what goes into this formula. And in this particular case, our numerator is going to be our cash flow from operations, which would be on our cash flow statement. And we're going to put as our denominator our net income. In this problem, the cash flow from operations is just listed in the problem, and that number is $30,000. And our denominator of net income is also $30,000. So in this case, our company is generating a cash flow yield of 100% of net income is generating into cash flow is generated by cash flow from operations. What that basically means is that for this particular company is producing $1 of cash for every dollar of net income during the past year. And again, you would just basically compare this to this company in previous periods as well as its competitors. Now let's look at the debt to equity ratio. Our debt to equity ratio reflects how well the company is financing its operations, and if it's financing its operations more from debt or more from equity. It basically shows the proportion of the assets that are financed by creditors versus the proportion of assets that are financed by its stockholders. So again, we're going to put in the factors that go into this ratio. And the first factor that goes into this ratio is our total liabilities. And the denominator is going to be our total stockholders' equity. So our numerator in this particular problem is total liabilities of $60,000. And our denominator is going to be $180,000 in stockholders' equity. This represents a ratio of 0.333. Okay, so that basically means that basically 33% of liabilities are used for every dollar of equity for this particular company. A ratio of a debt to equity ratio of 1.0 basically means that the company uses equal amounts of liabilities and stockholders' equity to finance its assets. So in this particular company, you can see that the company uses significantly less debt to finance its assets compared to its equity. That's a good thing. Next, let's look at the company's return on assets. The return on assets basically relates the profit margin and the asset turnover ratio. So in this particular problem, we have a net income as the numerator, and as the denominator, we have the average total assets, which we calculated previously, both of those two numbers. And so our numerator in this case is $30,000 and our denominator is $220,000. So this represents a return on assets of 0.136, which when we multiply by 100 represents a return on assets of 13.6%. What this basically means is that for every dollar of invested assets by this particular company, it generated a net income of 13.6%. That's a pretty good thing in and of itself, but again, you would compare this to the company itself during previous years and also compare it to other companies within its industry. Let's move on to the cash return on assets. This particular ratio is going to take the cash flow from operations as the numerator and divide it by the average total assets. And again, we have these two numbers from previous parts of this problem. The numerator is going to be 30,000 and the denominator is going to be 220,000. And in this particular problem, we're going to get a 0.136 answer, and we're going to multiply that by 100 again, and we're going to get a 13.6% return, cash return on our assets. This particular ratio is another measure of the productivity of a company's assets. It's basically relating the cash flow from operating activities to the average total assets that the company has on its balance sheet. So a ratio of 13.6% basically means that the company generated 13.6 cents of cash for every dollar of average total assets during this particular year. So this is basically a good cash return on assets. It's on par with its actual return on assets. It's not better, it's not worse. It's just another measure of the company's productivity. Lastly, let's look at the company's return on equity. And what we use here for this problem is the net income. And we're going to divide that by the average total stockholders' equity. And in getting the average total stockholders' equity, we're going to use the beginning and ending balances again. So in this particular case, the beginning stockholders' equity balance was 140,000 in this problem, and the ending stockholders' equity was 180,000, and we'll divide that by 2. And we'll get an average stockholders' equity of 160,000. And we previously got our net income of 30,000, so we'll use that as our numerator again. And then we'll take our 160,000 as our denominator. And we'll get a return on equity of 0.188, multiply it by 100. And we'll get an 18.8% return on equity. This is basically measuring whether a company earned favorable return for its stockholders. We basically always want our return on equity to be greater than our return on assets. And in this particular case, we do see that our return on equity is greater than our return on assets. Our return on equity is 18.8, and our return on assets is 13.6. And what this 18.8 is telling us is that basically our company earned 18.8% or 18.8 cents for every dollar of equity that the stockholders invested. And again, if I'm a stockholder in this particular company, I want this number to be higher. So this is a good thing. And again, you would compare this to previous years for this company as well as to other companies within this particular industry. And that's it for this particular problem. So hopefully this will be helpful to you in completing similar problems.